Finance 101. The bonds are prior claim in the capital structure. So any equity owner better understand where the bonds are trading. This is why things like AMC and GameStop, which had high yield bonds outstanding, and therefore guys that were short the equity against the bonds, they got railroaded because all of a sudden they do a short squeeze, right? And it's like they're putting on a good risk adjusted trade, but shorts, it's dangerous to be short, as you know. The bonds don't rally, but the equity goes through the roof. It makes no sense on an enterprise value basis, but that's the way the world can work. Okay. So
let me see if we understand this. I just want to unpack for the listeners here. So basically, if you're not really caught up with what he's saying, I mean, bonds are debt. So a company's taking on debt, and he talked about earlier kind of insolvency. So the company's taking on debt, that's their bonds, and then they have their equity price. Correct. The problem is that as an equity owner, when you own stocks, you own equity, you own the company, but the debt is senior
prior claim. So, correct.
What he's saying is that if their bonds aren't worth anything, then they're bankrupt, which means how can the stock be
bonds
worth?
Trade? Well, there you go. But let's just unpack that a little bit more. Bonds trade for a price as well. Generally, that price at issue is 100 cents on the dollar. Let's just assume the general level of interest rates don't change, and it's only the credit quality of the company that comes into play. If the credit quality improves and the coupon that the company was paying started as an 8% and it is fixed over time, and let's say the market says, wow, that 8% is now attractive because I think that company should trade at a 7% discount rate or a 7% rate in their bonds. I'm going to go out and buy some, and people buy it and bid it through par until the net present value calculation makes it worth a 7% yield. Conversely, let's say you bought it at an 8% yield and the company hits some cash flow problems, and all of a sudden you're like, geez, this 8% doesn't look so fancy anymore. So you turn around, you try and sell it, and maybe the market, trades in the 90s for a little, but then there's different levels of distress, and you go 90s, 80s. Yeah, things are still okay. But there's an expression: when bonds trade in the 60s, they don't trade there for long. They either go into the 40s or go back to the 60s. When they go into the 40s, that essentially means they're going to declare bankruptcy. And here's an example of sometimes equity analysts get out there and say, what about the equity of Hertz? Wow, that equity looks somewhat exciting. What if Hertz makes it through? Hey guys, check the bond price first, please. If the bonds are in the 40s, do not go out and buy the equity, despite what any analyst tells you,
right?
Including some editors of some very influential financial publications. These are horrendous advice of people that have not checked the capital structure. And I want to add one more thing. Why did the Fed get involved in high yield bonds for the first time in the history of the Fed ever saying they are going to, get involved in different markets? They picked high yield bonds this time, this COVID crisis. Guess why? There are four major American companies that if they got downgraded from their current cusp of investment grade into the junk bond or high yield market, they would overwhelm the high yield market. Those four companies, Ford, General Motors, General Electric, and AT&T combined have more debt than the entire high yield bond market. The Fed
What do you mean they would overwhelm?
Because their combined debt is greater than the combined high yield market in total.
Okay.
Can you imagine those four guys coming into the high yield debt market? The price of the high yield debt market would get destroyed.
Right.
The elephants are in the room. Okay. And these downgrades, they're forced selling coming out of investment grade accounts. The Fed had to walk into the market to stabilize the market, to be able to buy it in case these companies got downgraded from high grade to high yield. Sort of scary, but once again, I need to tell you, you have to understand where the bonds are trading before you worry about the equity.
Right. Yeah. Now, I mean, that would be typical what you should do, right? In a sense where I like to kind of use an analogy like playing blackjack. So a very simple game. Okay. You draw two cards and you try to get 21. If I drew a 19 and I was feeling really lucky and I took a hit and I got a 2, I win. But that wasn't the right move. Because if I play that way over a long period of time, I'm going to lose. And so kind of to your point, even though the bonds are saying do not buy this stock, GameStop, for example,
Oh yeah,
people did buy the stock and they made a
that
lot
was
of
a
money.
technicality. And there's enterprise value versus enterprise value being the value of the market cap of the company, the equity market cap plus the bonds gives you what's called an enterprise value. You're totally right. That's a technicality, but on a basis of risk return,
Sure.
you're not supposed to say hit me when you're at 19. You're not supposed to run in and buy, but life is a probability analysis. Okay. And sometimes you say hit me and sometimes you draw another ace. And maybe then you say, hey, I'm going to see if I can get that one last ace. And that's a 4 out of 52. Excuse me. It's a 3 out of 52 chance. Assuming the dealer doesn't have an ace as well, there's a 3 out of 52 chance I'm going to get hit on another ace. Like you can do that if you want, man. But look, that's not what you're supposed to do. Life is a game of probabilities. It's a game of smart investing. And yeah, that's exactly it.
Yeah. And if you can get lucky, but like I always like to say, like my wealth, my future is too important to leave up to luck. So you play the odds, right? You play the strategy that you know will win.
Please do. That's it.
Yeah.
All you can do is play probabilities. And that's why I always look at things on an expected value basis. That means the probability of some outcome times the value of that outcome. And you have to add these probabilities in good cases and bad cases, and you come with an expected value. That's correct.
Right. And just like in that blackjack game, you have to be okay. You're going to lose a couple hands, but you're going to you lose the battle, win the war kind of a thing, right?